Introduction to Enterprise Risk Management and Internal Control. In internal control, there are components of risk management. There are frameworks to follow. When we talk about internal controls, there are mechanisms to attain enterprise goals and objectives. Internal controls comprise policies and procedures. They are to become operationally efficient and effective, informationally valid, accurate and reliable, and comply with laws and regulation. The purpose of internal controls are to protect resources and to use resources responsibly. There are risks and opportunities in an enterprise. Risks are events having an unfavorable impact on enterprise objectives, and they require assessment and response. In contrast, opportunities are events having favorable impact on enterprise objectives. They are channeled back to strategy for strategic setting processes. Enterprise risk is managed across 4 objectives. Risks are negative and opportunities are positive in terms of impact on enterprise objectives. These 4 objectives are: the first one is strategic, is to align with the goals and mission. Second is operational, for the enterprise to be effective and efficient in the use of resources. Third is reporting, to enact reliable and relevant reporting. And fourth is compliance, to comply with laws and regulations. Internal controls are applicable and they become within and outside the enterprise. If you look at business intelligence of an enterprise, what we mean there is the collective memory of the enterprise to respond to the environment. This collective memory is obtained through 3 channels: enterprise resource planning. Enterprise resource planning has add-on software, and this add-on software is connected to various aspects of outside the enterprise. And this data flows through add-on software into the ERP to form business intelligence. Similarly, there are intelligence systems that enterprise resort to, and intelligence systems talk to the databases and also create new memory, and it flows into the database and it can influence the business intelligence. Internet of Things are products that the enterprise can make, and when these products are being shared with suppliers and customers, when they are connected to the internet, they can generate data that's relevant to the enterprise, and enterprise can capture those data, and that can enhance business intelligence. But when data is received by the enterprise, it has to be filtered. And often this filtering occurs through data rules and business rules or enterprise rules. We were talking about risk. There are 4 risk categories, and depending on the risk category is the appropriate response to the risk. The first one is to avoid the risk, that is, to leave the activity that gives rise to the risk. Second is to reduce the risk, is to reduce the likelihood of the event by taking preventive steps. Third is to share the risk by taking insurance or outsourcing that risk. Fourth is to accept the risk and then take no action. The risk response to a given event depends on the policies and procedures followed by the enterprise. An enterprise risk management framework has 8 components. The first one is the internal environment. It is about the risk management philosophy and the risk appetite of the enterprise. Some enterprises are prepared to take more risk, whereas others are not. Second is objective setting. Is choose objectives that are consistent with the mission and risk appetite of the enterprise. Third is to identify events with risk. Fourth is to assess risk on residual and inherent basis. Fourth is to respond to risk, either by avoiding, accepting, sharing, or reducing by responding to the risk. Six is to have control objectives through appropriate policies and procedures. 7 is to communicate and inform the relevant people about the risk that originates and persists in the enterprise. 8 is to monitor and manage and evaluate this risk. The systems flowchart can help in showing actions to be taken related to the risk that originates, and these risks could be embedded in the events and processes. When risk information is identified, captured, they can be communicated to relevant decision makers. If we take, for example, a tracking number, if there's some issue of malfunctioning of tracking number, that we know that tracking number would impact the deliveries and could also impact the supplier payments. And not only that, but even the events that occur prior to that can also have an impact, such as purchase orders and supplier dispatch and so forth. So therefore, flowchart enables us to pinpoint and focus on the relevant event or the process item that where we have to take a necessary remedial action. A risk management framework is vital to an enterprise. If we ask the question, why Arthur Andersen failed and was terminated as a business, it goes back to the point where the accounting firm shredded audit documents that obstructed justice. But that led from that is that the firm was under felony, and any firm that's under felony can't conduct audits. and they had to surrender their CPA license. But this event of Enron and corporate collapses in general highlighted some of the major events and actions taken in relation to internal controls. The first one is the Sarbanes-Oxley Act. This act, the main purpose of this act is to protect investors from fraudulent accounting. The second is the PCAOB, Public Company Accounting Oversight Board, that originated from the Sarbanes-Oxley Act, and the PCAOB is an oversight body that was formed to regulate auditors of public traded companies. The third is a committee of sponsoring organizations, and they were vested with the responsibility of developing an internal control framework. Fourth is the Securities Exchange Commission, and they have a mandate for the effectiveness of internal controls over financial reporting using a suitable framework using the definition of internal control, and they recommended the COSO, or the COSO framework that was developed by the COSO body. The key provisions of the Sarbanes-Oxley Act, which is to enhance the quality of financial reporting, created a new accounting oversight board, the PCAOB, strengthened the audit independence rules. For example, an external auditor that's auditing an entity cannot provide consulting services to that entity. Third is to increase accountability of company officers and directors. That leads to true and fair view of financial reporting. Fourth is to mandate upper management to take responsibility for company's internal control structure. Fifth is to combat white-collar crime with more severe penalties. The PCAOB auditing standard number 5 require that the management of each audited or publicly listed firm evaluate the design of entities' controls to determine whether they are adequately addressing the risk that are materially misstated in financial statements. Second is to gather and evaluate evidence about operations of its controls. Third, it also has the responsibility of aligning the nature and extent of evidence with assessment of the risk associated with those controls. Fourth, it might present a written assessment of the effectiveness of internal controls or financial reporting. Fifth is, as part of annual audit, the independent auditor must test and report on the effectiveness of company's system of internal controls. The COSO, Committee of Sponsoring Organizations framework, has 5 sponsoring organizations: the American Institute of CPAs, Institute of Management Accountants, American Accounting Association, the Institute of Internal Auditors, and Financial Executives International. On 27 June 2007, The Securities Exchange Commission issued a revised guidance that's relating to the management's implementation of the Sarbanes-Oxley Act, Section 404.15. This ruling states that the management assesses the effectiveness of internal controls or financial reporting using a suitable framework that contains the definition of internal control and suggested the COSO framework. Let's look at a risk management framework. The Committee of Sponsoring Organization, COSO, put forward a risk management framework where it considers internal control is a process effected by the enterprise's board of directors, management, and other personnel to provide reasonable assurance regarding achieving objectives in 4 categories. The first one is the effectiveness, that is, to the degree to which an enterprise accomplishes its objectives. Second is about efficiency, that is, the ability of an enterprise to accomplish objectives with minimal waste of resources. Third is about reliability of financial reporting. And fourth is about compliance with applicable laws and regulations. There are 5 components of COSO internal framework. The first one is the control environment. Second is the risk assessment. Third relates to control activities. Fourth, about information and communication. Fifth, about monitoring. So let's now look at the COSO framework, these interrelated 5 components. The control environment. It's influencing the control consciousness of its people. Second is the risk assessment. It's about identifying and analyzing relevant risk to achieve enterprise's objective and form a basis for determining how risk should be managed. Third is about control activities. It's controlling activities through policies and procedures to ensure that the management directives are carried out. Fourth is to inform and communicate to identify, capture, and exchange information in a form and timely framework that enables people to carry out their responsibilities. Fifth is about monitoring, a process that assesses the quality of internal control performance over time. This is a key element in the long-term success of an internal control framework. So let's look at one by one now. These components, the control environment. The control environment, enforcing the control environment through internal control, is enforcing the integrity and ethical values, commit to competence, use the board of directors and audit committees to oversee the policies and procedures, support management's philosophy and operating style, create an appropriate organizational structure, assign authority and responsibility accordingly, use human resources policies and procedures that are consistent with organizational objective. Second is about managing risk, assessing risk. First is to create company-wide objectives of risk assessment. Second is to create process-level objectives of risk assessment. Third is to identify and analyze risk. And fourth is to manage change in relation to risk assessment. The third component is about control activities. In controlling risk, the enterprise must follow policies and procedures that are enacted in that enterprise and keep improving security in relation to application and network. Conduct application change management and plan for enterprise continuity and backups. Fourth is about information and communication. Enterprise must measure information quality, measure effective communication consistently. Fifth is about monitoring. Is to undertake ongoing monitoring and to conduct separate evaluations. Fraud and its relation to internal control. First, we must understand what is meant by fraud. Fraud is a deliberate act or untruth intended to obtain unfair or unlawful gain. Fraud always entails manipulating information for criminal purposes. It's the management responsibility to prevent fraud and other irregularities implied by laws. Internal controls and audits are not wholly sufficient to detect fraud, but a system of internal controls and an ongoing process of review can reduce that incidence. For example, installing firewall or software following security rules can regulate the traffic flow, information flow with the internet. Computer crime in the information age includes where computer is the target of the crime or means used to commit the crime. First, computer can become a tool for the crime. For example, computer can be used as a tool to make unauthorized transfers from banking information systems. Second, computer can be a target. For example, accessing data through software secretly installed in it, like malicious software and malware. So we've talked about malware, malicious software. It's a way of committing computer crime. There are 6 types of malware. First, solemnizing. It is to systematically steal very small amounts from transactions through decimals. Second is backdoor, where a programmer can install a code to bypass security screens when once the program is installed or fully installed, then the programmer can bypass the firewalls. Third is the Trojan horse. is to maliciously destroy the data in the hardware. Logic bomb is the fourth, is a secret code that's included in the program that activates on a certain date or when an event occurs. Fifth is the worm. It's programming code that replicates in disk, memory, and across networks. Sixth is the zombie. It's a computer programming code that takes over the computer. Then the computer that's been taken over will populate programming code onto other computers through internet connections. But the original computer is not detected. So this malware or the malicious software are a set of instructions that are passed on to other computers or the victimized computers. Computer crime represents an interesting example of process failure. It has been estimated that losses due to accidental, non-malicious acts far exceeds those caused by willful and intentional mistakes. So the enterprise should recognize that the computer must be protected by a system of internal controls that are capable of preventing crimes, but also minimizing simple, innocent errors and omissions. A framework to design an internal control system. When designing an internal control system, the system of flowcharts helps. Because the system of flowcharts show the process flows, and the process flows will enable the enterprise to identify where and what type of internal controls that should be placed to control those processes and events according to the policies and procedures of the enterprise. As a manager, we can ask the question, what are your concerns about this process? If we take, for example, order process, what are the objectives and related risk? Let's look at a scenario. The first, all the orders are entered in timely manner, but there can be orders that are lost, stolen, or delayed. So there should be internal controls to detect them. Second, all orders are correctly recorded, but the enterprise might miss some orders or record orders that was not received from the customer or record amounts incorrectly. Internal controls should be in place to assure that these processes are conducted appropriately. Third, all the inventory changes are recorded correctly, and it's recorded for the correct item and amount. And internal controls can help. Fourth, accomplish all these activities, the processes, activities cumulatively gives rise to processes, and these processes are accomplished with minimum of resources, such as in relation to ordering, optimizing the sales representatives' time and resources, ordering to clerks' resources, and the computer resources. The purpose of internal control is to provide reasonable assurance of achieving objectives in three categories. First is the operation process control. In relation to operations, enterprise needs to ensure they are efficient and effective. Second is the information process control to ensure there's reliable reporting. Third is the compliance process controls to ensure that the enterprise adheres to the laws and regulations. A system of internal control can be arranged in a hierarchy. In this hierarchy, the first one is pervasive controls. These internal controls relate to multiple goals and processes. An example is a code of conduct that's required by staff members. Second is the general IT, information technology control, that focuses on information technology. An example is to prevent unauthorized access through passwords and firewall. Third is business process controls applied to a specific business process, such as billing or cash receipts. For example, check for efficient and effective operating procedures along with best practice. Fourth is application controls to automate business process controls contained within an IT, information technology application systems. For example, check for valid, complete, and accurate data. Another way to examine internal controls is the timing of occurrence in the design phase. First is to look at what are the preventive controls. They are the internal controls that are planned to stop problems from occurring. Second are the detective internal controls to detect and discover problems as they occur. Third is the corrective internal controls, why plans to rectify problems that have occurred. No internal control framework can be made 100% effective. This needs to be implemented with a combination of preventive, detective, and corrective controls. They all should come together to make the internal control framework work at its best.